Okay, everybody, we are live. I am so excited because we have a very, very special treat for you. We have Barry Habib, who really, the guy really doesn't need an introduction, but I will for those of you who don't know who you are. And if you have been following the real estate industry for a while, like I said, I'm sure you know who this guy is. He is a two-time crystal ball winner, which means this guy's been able to call some things that many experts have not. He is the CEO and founder of MBS Highway. He is a trusted advisor and mentor for not just me, because I've known him for years, but he has also been really a guiding light for a lot of the mortgage industry's top level CEOs, experts, and producers. Frequent guest on CNBC and Fox Business News. And like I said, daily, he has thousands of subscribers across the nation, really just looking to him for guidance on what we can do in this interest rate market. We also have Megan Anderson, who's joining us, who I have absolutely come to love and adore. She's a social media goddess. I'm telling you, if you're not listening to her podcast, you absolutely have to. Just gem after gem after gem is dropped on there. Plus, she's just a fantastic person. So I'm blessed to have both of them on here right now to kick off this live stream. And let's bring them both on. All right, guys. Good afternoon. Good afternoon. Thanks for joining us from the East Coast.
So happy to be here.
Yeah, great to be with you, Sean.
All right. Okay. Well, Barry, Megan, I'm going to just let you guys run with it. There's a lot of different topics we have thought to talk about. I know we wanted to talk a little bit about what the previous state of the mortgage industry was right before we got into this pandemic. So I'll let you lead off, and the show's yours, man.
Well, thanks so much, Megan. It's great to be here with you as well. And when we take a look at, we've gone through a very rocky period, and some people still struggling to go through. We've been blessed in the mortgage and real estate industry that we've been able to handle this and really succeed and thrive through this period of time. We've been able to adapt in working from home. But there were some scary moments, and I don't know if people really knew what was going on there, but it was kind of like the Cuban Missile Crisis moment where the mortgage industry was clearly on the brink based upon unintended consequences. Fed thought they were going to do some things that were helpful and beneficial for the mortgage industry, but they wanted to, with good intention, continue to buy mortgage-backed securities. But they got so aggressive with them, they created margin calls because pricing got so aggressive that their hedged positions for mortgage companies were at huge losses, and checks had to be written to the point where they were just startling amounts. We were very blessed. Our team was able to get in front of the Federal Reserve and was able to help them understand that while their intentions were well intended, they were doing things that were causing some potential dangerous situations for the housing sector. And they listened to us. They made some changes. And since then, boy, the market has been smooth. We've been getting through this. We've also really tried to do the best we could from the regulatory side, spoken to Mark Calabria from the FHFA, and our team has done a good job in helping to get the mortgage industry and the housing industry through this really critical time frame. And it appears now that while we're not completely out of the woods, that housing looks very healthy. The mortgage industry looks very healthy for a long time to come, with low rates for a long time to come as well.
And I think one of the biggest things I want everybody to take away from this is not only do you have somebody who has been a voice for loan officers for years. I know the first time I saw Barry speak, and I hope this doesn't date you, I was like 23 years old in Seattle at the Seattle Marriott. And you told this incredible story about how you actually had a mortgage deal going sideways because a husband and wife were fighting, and you actually sent the wife flowers on behalf of the husband. And it's something like I'll never forget.
Oh my God.
And I'm like, that's such a great move. I have not had to use it yet. But trust me, it's one of those things that you keep in the back of your mind. You're like, okay, that was a good one. But I mean, all of those things that Barry is, and now we've gone up to a government level to really prevent another 2008 from happening. And that's why I wanted to bring him and Megan on here, because that team at MBS Highway, again, phenomenal job. But they are being a voice for our industry. And real estate agents, home builders, if you're out there watching, this is going to not only tell you what has happened, what is happening, but he's also going to go into with Megan on what's going to come down the pike for us and how we can adjust our business model to make sure that we have a successful end to 2020. It's halftime right now. And 2021 has a solid foundation. So thank you, Barry and Megan, for everything you guys have done down there.
Thank you. Well, I think Megan will agree. One of the questions we ask all the time is does the stock market make sense at the levels that it's at right now? And I can tell you that while it doesn't make a lot of sense, there's the John Maynard Keynes had his famous statement that he said the markets can remain irrational longer than you and I can remain solvent. So it's kind of puzzling many of us right now. What is keeping the stock market up? It's really, even in the face of all this, the amount of money that the Fed is injecting in has caused the stock market to move higher. But there is precedent for this. After the 2008 crash, the Great Recession, after the dot-com bubble in 2002, and after the Great Depression, at the stock market crash that had occurred, you had seen very similar moves higher. In fact, it's very eerily similar to the 1929 crash, where the stock market from that level moved up 48%. Interestingly enough, just recently from its lowest level, the stock market here moved up 47.5% before kind of faltering a little bit that big day where the Dow dropped about 1,900 points. And when you see those similar moves, Mark Twain said it best. He said that history doesn't necessarily repeat itself, but it does tend to rhyme. So we're seeing some rhyming situations out there. To us, it looks like the stock market might be a little ahead of itself. I don't know if there's going to be a big crash like we saw before or a prolonged situation. Who knows? But it does look to us that a pullback towards 2,800 on the S&P probably is in the cards. Nothing is certain because things can twist and turn, especially with results on how this comes out with virus news. In other words, a therapeutic, a cure, more in lines of a vaccine, I should say. These are the things that are causing this market to be so skittish and move so rapidly. So that's one area. My advice, I think, Megan, you would agree that just this is a good time to just be a bit cautious, right?
Yes, I would definitely agree with that. I agree with you that it's going to take some resolution of this virus for us to fully recover.
Yeah, because even though we have come back, even if the economy does come back optimistically, 90%, it's that 10% that keeps a lot of those businesses running profitably. So I think there are some challenges that we'll have to face, and certainly we'll get through them. But I don't know if things are as rosy as far as the stock market's concerned as it's being portrayed right now. Now, speaking of rosy, the interest rate picture does look rosy. Housing does look rosy. We're going to get into that. So if you'd like to, Sean, we can kind of share our screen.
Please, man,
please. I can go over some thoughts on that. So what we're going to do is we're going to begin with, we'll take a quick look. Tell me if you could see that.
All you, man.
Okay. So what I'm going to do is I'm going to bring up the slides that Megan and I have created. Megan does look terrific on there.
She looks fantastic. This is great. And I love the book. We'll talk more about the book at the end of this.
Yes, there you go. So listen, we know that right now people are waiting longer to get married. Wouldn't you say, Megan?
Yes, they are waiting longer to get married. There's no rush. We can tell by this graph.
Yeah, people waiting to get married to about age 30. And what that means is that a lot of times people are waiting a little longer to have kids. And kids are a big factor in home ownership. Take your millennials, they're between ages 30 and 39. If you're a 30-something today and you have no kids, it's a 38% rate of home ownership. But just that first kid, that first one, bumps up home ownership to 80%. So we know kids drive home ownership, drive buying and moving from renting to owning. And what we know after COVID is people want more space and more distance. But what's really interesting is that maybe it's a result of COVID, right, Megan? But look at the Google trends.
Oh my goodness!
Everyone's been locked up, nothing else to do but Netflix and chill, right?
That is very true, and I want you to know, as soon as Barry started talking about the waiting a little longer to get married, there's probably a ton of boyfriends inside of the mortgage and real estate industry that just started sweating bullets. I could feel it all the way here on the West Coast, man.
So when we take a look at this and we say, okay, baby registry, that means that there's probably going to be a drive for home ownership, since there's probably one reason why you're interested in baby registries, right? So you take a look. people wanting space and distance, they're moving out of urban areas. That's where you're seeing the exodus. But where are they going? Suburbs have always been hot, but what's really gaining momentum is the exurbs. If you're not familiar with that term, the first ring is obviously when you go from urban, outer ring becomes suburban or suburbs, but it's the next ring, the exurbs. That's where the magic is going on right now. And surprisingly, guys, what is driving this are very young people. It's really all coming from under 35. Now, the homeownership rate in the United States has gone from 64% to a little over 65% in the home, and it's all being driven by those under 35, specifically under 30. Look at what's happening here. Huge homeownership increase in under 25 even. And, Sean, you said you were 23 years old at the time, and you were obviously very enterprising even at a young age. But a lot more people are falling into that category where they're not waiting, even under 30. Look at the huge growth in home ownership, and under 35, it's all happening here. And if you think about it, they are doing most of the transactions. Now, if you wait to try and do business with people that are a little bit more established, a little older, yes, they are going to do transactions, but at a much slower pace. If you're over 50, you might have a transaction once every 12 years or so. But look at this. If you're under 35, people are moving every 3 years. So that's 3 transactions to 4 transactions for every one that somebody over 50 is doing, which means that if you're going to think about how you're going to capture this, you've got to be very active on social media. And I know, Sean, you're a great social media expert, but Megan, if you're going to be doing this and somebody says, hey, you know what, I'm on social media, I've got LinkedIn, and I'm active on LinkedIn, I'm active on Facebook, I'm all set, right? What would you say to that, Megan?
No, you have to think about where this target audience is. And as we're seeing, it's the younger individuals that are taking up the majority of home ownership. So you need to be focusing your efforts on where they're spending their time on social platforms. So when it comes down to it, if you're telling me that you're spending your time all on LinkedIn or Facebook, well, that's great. But all of these younger individuals are spending the majority of their time on social platforms like Instagram. So if you wanted to target that audience to drum up more business, I would tell you to really focus a lot of your efforts on Instagram. But it really depends upon your target audience. I mean, if you're doing reverse mortgages and that is your clientele, then you'd be wasting your time on Instagram. So just think about who your target audience is and where they're spending their time.
Completely agree, Megan. And, we talk about the housing market. The housing market can be viewed very differently. The media sometimes gets focused on housing, the driver of economic activity. But for all of us and our customers, they want to know, hey, is the house I'm buying going to appreciate? Is it a good investment? And indeed it is. Because if you go by the basics of economics and you go by supply and demand, we already know inventory is tight. But guess what? It's going to get tighter because all these young people are going to be coming in buying first-time homes, which means they're going to be depleting inventory. They don't have a house to sell. Who makes up that inventory? Builders. But builders have been impacted by what's going on in COVID. Now, we already know inventory was tight. Builders weren't keeping up. But look at the 2020 estimate. Look at this big drop in newly constructed homes. We saw the data just come out today. And why is this? Because you can't get workers back to work that easily. You can't get land that you're being purchased. It has become more difficult because of COVID and the lockdown. So we will see much less of an influx of new homes that are being built. And we were already light. It's going to be much lighter. It's not going to be back until 2022 that we get back on the trend we were. And the trend we were in wasn't sufficient enough to handle the demand anyway. So what does that mean as far as real estate, the investment? It means that whenever you have a situation with more demand and not enough supply, what do prices do? Prices go up. We know that prices on real estate are going to go higher. Now, we already had the lowest amount of inventory on record, and it's going to get tighter. In fact, unlike other markets, vacancies are extraordinarily tight. The last time vacancies were this low was back in 2001, and that was one of the best buying opportunities that was out there. This buying opportunity will rival that, so you're going to start to see that. We take a look at the fair value of housing. One of the great metrics that we look at, Megan and I and Dan here, we all look at different metrics. And one of our favorites is to look at the fair value of housing based on the price to rent ratio. It's allowed us to do a lot of handicapping that's been effective and define where we might see a problem market. And we use the price to rent ratio, and currently it's at 17, meaning the price of a home is 17 times the rent. So let's do a math equation here. If your rent is $1,000 a month, 12 months in a year, $12,000 a year for rental income. So if you multiply it by 17, it would give you the value of a home of about $194,000. Or said differently, a $200,000 or so home would rent for about $1,000 a month. And that's where today's market is. If you go back to the last time that housing started to get into trouble, in 2006, it was 24 times. We knew that the market was overpriced. We're nowhere near that right now. So we've got a long way to go before housing starts to appear frothy. And in addition to that, the health of the housing market fundamentally is so strong. Now, Sean, you probably remember this, but when we had a very popular term was upside down on your home. 25% of homes were upside down, meaning you owed more on your mortgage than the value of your home. How much is that today? A meager 2%. And 34% of homes, no mortgage, positive equity, 63%. Let's take a quick look here at housing overview. So it's 124 million households, 43 million rented, 80 million owned. Of those homes that are owned, 27 million of them are free and clear, no mortgage. What does this say to you? It says, if you're a mortgage professional, cash out refi. If you're a mortgage professional or realtor, move up buyer, move up buyer, move up buyer. They've got plenty of equity. 53 million, the other 53 million homes that have a mortgage, you know what the average loan to value is? 50. What? The average equity in those homes, $177,000. Team, this is the jackpot, okay? There's never been a time where rates have been this low, but on top of that, super hot housing and unbelievable amounts of equity. There's never been a time like that. This is your time. This is like winning the lottery right now. If you're in the mortgage or real estate business and it's your choice, are you going to cash in that lottery ticket or not? By cashing it in, this is the time to work and go after it and work smart. Now, the appreciation forecast, Megan and I, we work up these numbers along with Dan here, and our team has come up with some very good numbers. As you were kind enough to mention, we won Zillow's Crystal Ball Award 2 out of the past 3 years for out of 150 economists having the most accurate real estate forecast. And what we're saying is that real estate values will go up over the next several years, and by a significant amount. There is just not enough demand to meet supply. Prices have to go up, and there is room for them to go up. Now, when you look at your market where you're at in King County, and I know this is something you do quite often, is you have a real estate report card. Now, there's so many things on this real estate report card that people could see. All you do is put an MLS or a zip code here, and you could bring up the actual home and the price. And what you'll see is how much that home will gain in just the next 5 years in King County, Washington, specific to the zip code. There are different zip codes in King County, but each one will show up differently. You could put in whatever your zip code is. You can see in the next 5 years, prices are set to appreciate by 26%. So,
and Barry, just one thing, I know you're on a roll here. I want to put this out there. I get it. There's a lot of lenders that are on here, a lot of Loan Depot folks, a lot of real estate agents and home builders. What Barry's about to show us is pure gold. And if you're not in the Washington State area, especially, and you are, looking and, you got loan officers calling you all the time, a good qualifying question to ask them is, are they a subscriber to MBS Highway? Because then you have access to these tools. Then you have somebody who's constantly in the know, and somebody who has won Zillow's 2-time Crystal Ball Award, giving them information to give you and your clients about interest rates. So with that being said, Barry, run with it, man.
Thank you, brother. So what you could see here is this has a very young demographic. This zip code, very young demographic, people ages 27 to 35. There's only 2 homes available for every 1,000 people. So when we talked about before, first-time home buyers, there's a 58% home ownership level here. But a lot of these people that will be first-time home buyers in the next year, 21,000 of them, builders are only putting up 15,000 homes. So you have a housing shortage in this market. Although prices are not inexpensive in this zip code, look at affordability. It's actually rising. And unemployment, the national average is 13.3%. In this market, while it's gone up, of course, it's 8%. So double the national income. And you can see jobs have slowed down in their creation because of COVID. But this is such a great market. You should be screaming this from the rooftops. In fact, why don't you put this on your website? There are many tools that you could use, like a buy versus rent tool that's like none other. This real estate report card, which will show up for every zip code. If you're a real estate agent, you want to put this right on your website, and you can do that with what we're doing. But meanwhile, Megan, one of the other things is the fact that we want to get those buyers motivated, and we want to do that by showing them that they can miss out on opportunity. If somebody's out shopping, right, Megan, and they don't find something because of lack of inventory, what might they say?
They get a little discouraged. They might say, maybe I'll wait 6 months to a year and readdress this. but that's not what they should be thinking. And Barry's going to walk through this piece that can really help light a fire under their rear end and get them excited about moving forward and purchasing.
And I want to put this out there. We get this question so much, especially right now. And this is one of the main reasons why I wanted to have Barry and Megan on here. They're about to give you the script that really can help motivate those sellers and those buyers. You know, this cost of waiting, watch this over and over and over again. And I'll give you access to the tools. Please just give me a call. But you want to know this because how many times do we get presented with that phrase, you know, I think we're just going to hold off. I think we're just going to wait. This is the real cost of waiting. So please, Barry.
So depending on their zip code and where they are, you can say to them, look, I understand that you're a little discouraged. You spent a couple of days, you didn't find anything. It's true. Inventory is tight. I get that. But, you know, it might pay for us to keep at it and keep waiting because keep working at it, because if you wait even just 6 months, while you're on the sidelines, the market's still moving. And in this particular zip code in King County, prices are set to go up 1.93% in just the next 6 months. That might not seem like a lot, but you would have lost $12,000 on this home in appreciation, $5,000 in amortization. You lose $18,000 by waiting 6 months, and then your new monthly payment would be $55 a month more than it is today, even if rates stayed this low. So what I'm saying to you is, are you sure you want to wait, or would you like to continue shopping? And I think that most real estate agents are discovering that clients are all over this. And remember, I talked to you about how can you help real estate agents if you're a mortgage professional that uses and likes the tool like the buy versus rent that we have, or what I just showed you on that real estate report card. It could be for any zip code. But meanwhile, that mortgage professional can help drive traffic to your real estate agent's website and be on that realtor's website with this tool. So they'll drive traffic to the realtor, and the mortgage professional benefits as well.
And another tool that can be really helpful is open house flyers, as we all know. And I also know that still in a lot of places, it's a little bit slow on showings. I know here in Florida, we just opened up a few weeks ago to be able to show condos. Well, at MBS Highway, not only can you share the open house flyer as a PDF to bring physically, but you also have it in link format. So I know a lot of you real estate agents that are on here have been doing virtual house tours. Well, you can reach out to Sean or whomever, and they will get you the link so that you can have this be interactive on that post. And we'll also share everything that Barry just broke down. We'll share different loan options that they could go with. We'll share that cost of waiting to get them motivated with moving forward and purchasing. We'll share with them appreciation, buying power. And then the last piece is fun little demographics, where the different school systems, you can edit these depending upon the potential buyer, places within so many miles. They can actually get directions from this as well. And then we'll share with them restaurants. It's a really great piece.
Now, I know the Fed just this week talked about the fact that they said, okay, look, we're going to keep rates low for a long time, but that doesn't necessarily mean mortgage rates. Our customers can't get complacent. And it's helpful to show them charts like you showed them, shown just like this one, which the red line is mortgage rates, the blue line is the Fed funds rate. Now, over time, they might move somewhat similar, but they're very different. And the best way to explain it to our customers is, think about it this way. If you were lending money and you knew the money you were lending out, you could give a rate today, but you could change your mind on it tomorrow. So I can give you a rate of 1% today, but make it 5% the next day, 8% the day after that, 2% the day after that. I could change it from one day to the next. That's the Fed funds rate. But a mortgage rate, if I tell you what the rate is, it's got to be in place for 30 years. You're going to think about that very differently if you were the one lending the money. And you could see how the behavior is different. Here, Fed funds rate goes up in blue, mortgage rates go down. That doesn't seem to make sense, right? Fed funds rate goes up, mortgage rates go down. Fed funds rate up, mortgage rates down. But now, sometimes the Fed funds rate goes up and mortgage rates go up. Sometimes the Fed funds rate goes down, mortgage rates go down. Just like you see here, Fed funds rates down, mortgage rates up, down, up. But then it comes down later. They move differently. Now look, the Fed had the Fed funds rate just like it does today at 0. At the same time, mortgage rates were at 5. Okay, so we've seen mortgage rates at 5 as recent as the beginning of 2019. It's just a year and a half ago that mortgage rates were at 5. So where we are today is truly a gift. And let's not hold off and wait and say, hey, wait a minute, let's get greedy and try and get another eighth in rate.
Right. Right.
You're going to be in a great position right now. Sean, speaking of rates, it's almost a year exactly to the day where I made that crazy prediction, which kind of shocked the industry. And I went on every form of media. You could pull it up.
Oh, I saw. Yeah.
Rates were, the 10-year treasury was 2.75. Mortgage rates were much higher. And I said the 10-year treasury is going to 1 and mortgage rates are going to go much, much lower. And no one believed it. Everybody thought I was nuts. Very well-respected people thought I was crazy. And, it's so funny too, because, Megan, myself, Dan, we were predicting for a couple of years, we said 2020, we see a recession coming.
Yep.
Before anybody thought of COVID, right? And
yes,
the stats have now come out. February of 2020, we were in recession before COVID hit. And that's what drove our thinking to think that the 10-year treasury is going to go to 1, which it did go to in January, February timeframe as well. So when we take a look at that and we say, okay, let's apply those metrics to what's going on today, we were asked, okay, Barry, you got this one right. Megan, Dan, you got it right. What do we do next? So when I went on Fox, they asked me, okay, now the 10-year treasury just broke below 1%, which you told us was going to happen. Where's it going to go? I said it's going to go to 0.5%. They wanted to debate me, argue with me. All kinds of people understand it's never going to happen.
You were ridiculed. They were throwing, oh my God, this guy's out of it. This guy's out of it.
Yeah, but sure enough, not only to go to 0.5%, it went to 0.31. So we believe that rates will have a lot of pressure to the downside. How far down they go, it's a little bit hard to say, but there is a lot of things. The government debt will pressure rates lower. People, as they get a little older, will come out of stocks and go into more bonds. That will pressure rates lower. So we see a lot of reason. Now, that doesn't mean that they stay low forever and don't move. It's not going to happen in a straight line. There will be some volatility, but the upward price moves might come from time to time, even in the near future, as demand for products and services come back to our economy, but maybe the workers aren't there. Maybe companies at 80% or 70% capacity say, I can't stay in business unless I raise prices. And all those things could have a short-term inflationary move. Those short-term inflationary moves might result in interest rates bumping up a little bit. So this is a good opportunity. Now, longer term, I think that rates come back down and stay pretty darn well. But Megan, one way to communicate this is with this amazing tool that you've helped us create, Social Studio.
Yes, so you need to be doing video. I've said it before, I'll say it again. You need to be positioning yourself, no matter where you are in this arena, as the trusted advisor. And we have a tool to help make that happen and help make it easy. It's called Social Studio. We have pre-created scripts in there because the number 2 things that I hear of why people are not doing video is I don't know what to say and I don't like the way I look and the way I sound. One, every client knows what you look like and what you sound like. So you've got to just break through that barrier. And then as far as not knowing what to say, use a tool like this. We know that these scripts go over well. It essentially turns your computer screen into a teleprompter. If you can read, you can make a video. And once you do enough of these to where you get consistent, you'll notice that confidence and that little judgmental voice that keeps you from taking action will not so much step to the front anymore. It'll take a back seat. But get out there, do video, position yourself as the trusted advisor, and ultimately, we're here to help.
And I can say that I've used this myself. This is definitely something that I have implemented. And now it's inside of my office and inside of my house. I've got the whole green screen set up and all of the lights and everything that you can get off Amazon. And I have real estate agents that are friends of mine that are utilizing your guys' script. So I can definitely speak to the power.
Love it.
So simple, so easy to use.
Just want to show one final thing, just because people are telling us in the mortgage industry, they're doing very well right now. They're having record months, and people that are in the real estate industry are saying they're seeing great activity. And my simple question to you is, so what are you doing with all the success? What are you doing with the money that you're earning during this successful time? You don't want to either miss out or work the minimum amount. You don't say, look, I did a loan or I did a real estate transaction. I could kind of take some time off now, because you don't know when you're going to have this type of amazing opportunity. This is the time to go at this while it's hot. Make hay while the sun's shining is the old saying, and man, it has never been brighter than it is right now. So what I'd like to show you is a way for you to kind of convert that into something pretty meaningful. Right on our website here, you have a little retirement tool that you can use. So let's just say I'd love to have a $100,000 per year annual income after I retire. So let's just say your current age is 39, your retirement age, maybe 67, maybe you have $80,000 in the bank, and you think you get a 9% rate of return before retirement, a 5% rate as you go more conservative after retirement. This will show you that you need to be saving $719 a month. And some of you might look at that and say, wow, I could probably do that. Well, doing that will give you a $100,000 per year income for the rest of your life after you retire. And that's something that we need to be considering while we can make money today, while we can make it at a good level, but many people don't. There's a great book called The Richest Man in Babylon, Sean. You probably remember. I used to talk about it all the time. I used to buy a copy for all of my clients at closing. In fact, I made my kids, all 4 of them, read the book before they were age 12. It's an easy read. It's only 100 pages, and it is a book that you can pick up on Amazon for like $4. I used to buy it in bulk and give it to every one of my customers. And what it teaches you really is to pay yourself first. And in this particular case, it's so important. Now, when you want to be an advisor, maybe you're doing a refinance for somebody, maybe you're helping a customer, and maybe that customer would like to have a $50,000 a year income. Maybe they've got $60,000 or $65,000 saved. They'd have to save $178 a month. And you think about it. If you're a realtor, you give that customer a great deal on a home where they could save some money. If you're a mortgage professional, you refinance somebody. If you save them $200 a month, that's like $6 a day. What's that customer going to do with $6 a day? Now, no doubt they should save $200 a month, but $6 a day, what is that going to do for you? Instead, why don't you take that, speak to your financial advisor, and now utilize that. And instead of this refinance just giving you $6 a day, let it give you a lifetime income of $50,000 a year after you retire. These are the types of discussions that we need to have to elevate ourselves from a salesperson to an advisor.
Wow. Barry, that is such huge information. I know I personally read that book myself, The Richest Man in Babylon. It was just absolutely incredible. And now you have your book that is coming out.
Oh, we do. Yes.
So anybody who shares this live stream, the first 10 people, I've already I'm purchasing order of Barry's books, and we'll definitely send you a copy of that, whether it's from Amazon or we'll ship it to you from us. But please, Barry, tell a little bit about your book before we let you go.
Thanks. It's called Money in the Streets. And Money in the Streets is something that will help you to identify opportunities. Opportunities are everywhere. But there is an art form, and it's a learned skill to be able to identify them. We go through that. And if you're going through a great time, we'll help you maximize it. If you're going through a difficult time, the book will help you get through it. And it's just a wonderful collection of lessons and stories that I think that everyone can benefit from.
Yeah, absolutely. Man, I can't wait. I can't wait to see it. Can't wait to read it and get the copy in my hands. I think it comes out.
It's a good book.
It comes out in October.
October 27th is launch date. Yes.
October 27th. Awesome. Well, man, I mean, I don't know if you guys have anything else to talk about, because this is way more value than I think anybody thought we were going to get here. Please share the live stream. Make sure we'll get you a copy of Barry's book. Megan, you are absolutely incredible as well. Those Social Studio scripts are phenomenal. Everybody needs to jump on those. So yeah. All right, you guys.
Thank you.
Well, thank you. So next up.